Hey everybody, welcome back to another episode. In this video I want to share a practical and awesome scenario with you that, if you backtest it and use it in your trading plan, will definitely increase your win rate in trading. In this episode, I want to teach you 3 of the best setups in trendline. The idea that trend is your friend, trade with the trend is good. The first strategy is the third touch of the trend line in the direction of the existing trend. Trend lines often act as support lines for prices. Unlike complicated strategies with the usage of many indicators, the third touch requires only one element, a trend line. Now, we all remember from high school geometry how it takes 2 points to draw a straight line. But that line only becomes a possible trend line when you can extend it, while maintaining the same slope, such that another price low touches the line. It is assumed that all of you know how to draw a trend line. According to the 3-touch support strategy, you are to buy right after the third touch of prices to the support line in bullish trend and sell after the third touch of prices in bearish trend. Let's consider the steps that you need to follow. At first, let's look at the scenario when you want to open a long position. You see the bullish movement and draw the trend line, which connects 2 lowest points. We wait for the correction to the downside and enter the market after the price touches the trend line for the third time and the bullish candlestick is formed. We open a long position at the closing price of this bullish candlestick. We place a stop loss below the bullish candlestick level. I will show you how to enter into a trade in various methods. Another method of entry, particularly in higher time frames, is the breakout of the internal trend line. Here, we should use fractal timeframes and enter the trade on the trigger time, after a break of the internal trend line. In this method we set stop loss below the last low and enter the trade after the breakout candle. Another method of entry is to enter after a structure breakout and the formation of an order block. After the structure is broken and an order block is formed, we enter within the created order block with a stop loss placed below the order block. When you use pivots for entering a trade, you should wait for the third touch of the trend line to see a pivot formation. After the pivot is formed, you can enter the trade on the return to the pivot. In fact, all the entry methods are the same with a little difference and different names. The second strategy pertains to the third touch of the trend line in the opposite direction of the trend. In this example, we consider an uptrend. We observe the first touch, the second touch, and the third touch on the channel. When we want to trade the third touch, it's important for us to analyze how the market has approached that point. What I mean is that we need to observe how the leg approaching the channel is moving. If it is moving with equal legs, we can consider being a seller at the ending of that leg, at least until we reach the same leg starting point. Again, focusing on the third touch, how did this leg reach this point? Yes, it arrived with equal legs, which indicates that a consolidation has taken place here. This could represent a good opportunity for entering a trade. Let's look at the chart, and I can explain it to you visually. You draw the channel and observe the third touch, checking to see if the market has reached the channel level with equal legs. When I see equal legs, I conclude that a consolidation has occurred and the market has covered the range it intended to. Therefore, I can consider being a seller against the trend until the start of that same leg. You can enter either with a market order or, if you want to be more certain, wait for confirmation to be a seller. Okay, let's go to scenario 3. In this scenario, if in the third touch of the trend line the price is not supported and instead forms a range, meaning the price is unable to make a higher high, we will see that a downward leg forms, exactly the same size as the previous corrective leg, below the range level. This means that, in fact, it is giving you the target area. Let's look at the chart, and I can explain it to you visually. In this case, the first touch, the second touch, and the third touch. If the price does not find support and instead forms a range, it indicates that buyers are unable to push the price higher. This is a sign of weakening momentum. As a result, it may lead to a breakout below the range, potentially creating a new downward leg. After forming a range, if the price is able to close below this range, we will enter a sell position, and our take profit will be equal to the size of the previous downward move. Use on trending charts such as the Dow Jones, Nasdaq, S&P, and of course, gold. Reward 2 is the safe mode, take back test for more reward. One of my main setup on Dow Jones in 5 and 1 minute. This setup happens almost every day. I post many tips on my page that will help you gain a better perspective on the market. If you want to improve your trading journey, follow this page and support me with likes and comments. Good lucks!